Good morning, everyone. Welcome back to my channel. Got another video today. And today's video is going to be it's interesting. It's different. This video is going to be for beginner investors that are trying to figure out their niche of different type of index funds, ETF stocks that they want to invest into, and the common mistakes that new investors tend to make. And I'm going to cover that, and then I'll also give you guys a couple options of ETFs that's different than the norm of VU and VTI that I normally speak of. And so my job is to familiarize yourself, guys, with new stocks and new ETFs and give you greater exposure of ETFs and investing tools that you probably haven't heard of or in the mainstream that doesn't really normally talk about. And we're going to talk about that today. But before we start, like and subscribe to my channel. Watch the video all the way through from beginning to end. This is going to be great content because I'm pretty sure there's going to be certain ETFs that you've never heard of before. But if you're in the investing community, I know you've heard of it because more bigger channels have talked about this. But yes, share this content, and if you want to learn more about investing, subscribe to my channel. I have many videos of dividend investing, just investing for total return. So whatever your niche, from REITs, fund rise, I have the video in my repertoire for you guys. Hey, content is for you. I'm the wingman. So for today, we're going to talk about so the one of the main problems and issues with new investors is that you don't know where to do the research of what funds to invest into, or when you're starting out, you only have a just a small supply of just capital, and you want to find the best, or if you have some core positions like VU or VTI, you want probably some other funds, maybe one or two that stand out, that's going to grow your wealth, and that's not going to take too much from your particular strategy. But most importantly, as a new investor, most new investors don't even have a particular investing strategy to begin with. So I have this article, and in this article, it came out January 11th, 2023. And it says, think twice before buying the top 10 ETFs of 2022. So one of the main issues of new investors is that you tend to, one of the things that you're typing to do is, if you don't know, what was the top ETFs or funds or stocks that produced returns from last year. And you think that basically, remember, again, also, past performance does not guarantee any future performance. And just remember also, this for educational purposes only. But for this, you learn that basically that with the stock market, returns are not guaranteed. That's why even with my precautionary tale, or what I just said, that cautionary, past performance does not guarantee future performance. In this, a lot of times when new investors, when they start out, they don't know what to invest into. They think, oh, type into Google, what's the best funds that produce a certain amount of rate of return, and they look and see, oh, last year these funds produce outworldly returns, but then think that maybe going forward 2023, that's going to be the case. Not so much. And we're gonna go through that. And so right here it says last year was brutal. So investors who invest to the S&P 500 VU, or a proportion of VTI, gave up more than 18% in 2022. And the broad bond market surrendered 13%. And so while many ETFs are designed to track the broad market, more niche offer investors exposures are virtually any slice of a market. So basically what it's saying is that so the VU, S&P 500, VTI is the total stock market, but then also some investors invest into a small slice of niche of the market, like semiconductors or consumer staples like Coca-Cola and Pepsi, or consumer discretionary like Tesla, Lowe's, Starbucks. And so you can invest into the broad market, or if you like particular sectors or industries, you can also, as an investor, you can fall in love with, you know, the niches like that. And so the top funds, top best performing funds in 2022 was MSCI Turkey ETF, oil, uh, oil equipment, Vanguard Energy. So as you see, everything that was up from last year was energy. And so this could be misleading as a new investor, because if you don't do one, all all of your research, if two, if you don't have a overall broad investing strategy, you can fall in trouble, and would have an issue, because basically you don't see the whole entire story. So the whole entire story is that because of COVID, everyone's stayed in the house, wasn't really using jet fuel like that. So oil prices, were down. But then going to the year after that, we began to, the demand for oil went up. Just think of economics, supply and demand. There was no huge need to burn oil, to use oil, because no one was traveling. We had, stay in the house mandates for 2020, and so we're going to 2021. The demand for oil energy went up because, of course, the supply and demand is more supply, so we're going to increase, jack up the prices. And so, as you see, the oil and the energy sector, which normally is cyclical, and a lot of times, like for my investing history, the oil industry and the energy industry, it's like, of all the sectors, typically it's one where the prices are like really low, but then it has like high dividend yields. But right now, ExxonMobil has a dividend yield of roughly like 3%, and it's unheard of, because I'm so used to my investing history, ExxonMobil having a dividend yield like around 5 to 6%. Crazy, right? Crazy how things changed from year to year. But as a new investor, you will know that. You will know that, if you're not doing research, that the energy sector is very cyclical. And so sometimes the prices are up, sometimes the prices are down. It just goes with the times. And so, so as an experienced investor, you know that, like, when the market was down 18% for the S&P 500 for 2022, that that instead of looking at it as it's all bad, you saw it as a buying opportunity to buy more, and not shy away. And so one of the main issues is that a lot of times people get caught up like what's the best performing ETF, instead of following your particular either dividend strategy of stocks, or particular stock like Tesla. Tesla was down over 50%, but knowing that if you have high conviction and you in Tesla, you believe in Tesla, even when it's down 50, 80%, 90%, you're still gonna buy it, because you have high conviction and know that in the future it may go up. Or that's just an example. So moving forward, so the next we're going to move forward and give you examples of ETFs or investing tools that you probably haven't heard of, or that's not so common. So one is called VUG, Vanguard's Growth ETF. I like Vanguard's Growth ETF. It costs $233 per share, and this is for new investors who, you have about, you have roughly 15, 20, 25 years to grow your money. You want to get a lot of bang for your buck in terms of returns. The holdings in Vanguard's Growth ETF, VUG. So first off, it invests roughly into 40% into the tech industry. So keep that in mind. That is grossly a high percentage, but they are betting on you wanting to, tech is the future, right? And then, so the top 10 holdings of VUG, Vanguard's Growth ETF, it's the growth that's super big, right? Apple, Microsoft, Amazon, Google, Tesla, Nvidia, Visa, Home Depot. So as you see, 9 of the 10 companies in the top 10 are tech. I mean, it is 40% growth, but it also invests into consumer cyclical as well. It do invest into Home Depot. Home Depot is the housing market, right? So Home Depot, Lowe's, housing market, right? Uh, so then with a growth ETF, you really don't focus on dividends per se, but with anything that you're investing to, you always need to pay attention to the expense ratio. The expense ratio is what you are going to be paying out in terms of just think of it as like a finder's fee for even owning it, right? So you're paying, it's a fee, and so if you if you buy like 10,000 worth of VUG, all you gotta do is take 0.04% divided by 100 times it by 10,000, and that's what you get. How much of a fee that's going to come out your returns, right? And and what you also got to realize that with the expense ratio, the lower the expense ratio, the better for you. More money in your pocket, right? And so, but yeah, VUG is definitely has great upside. It does pay a quarterly dividend. It does have a bang for its buck. Of growth. Last 10 years, it has grown 209%. So, Rule 72. That means your money would have 10 years ago. If you would invest 10 years ago, your money would have doubled. 14, almost. It most definitely would have doubled twice. Like two and close to 2.5. Your money would have doubled just for 10 years. Imagine holding your money 25 years, 30 years. Your money would have doubled. Holding it for 30 years, money would double easily 4 to 6 times. So the next particular stock that ETF, I know that a lot of people have not heard of or not paid attention to is SMH. I know the acronym right, second in my head, right? But SMH is it's a Van Eck semiconductor ETF. It costs $237.03. And I know you're like, why you bring this up? One, because it's new in terms of I know a lot of people don't speak about it, but I'm gonna have had a love for semiconductor stocks, and even though I know like the tech is the future, for me, I believe that also semiconductors, microchips, chips are the future. Chips are in our phones, calculators, cars, billboards, TVs, everything that you see, it runs by chip. And so, Taiwan Semiconductor, Nvidia, Broadcom. I have Broadcom in my dividend portfolio. I have Texas Instruments in my dividend portfolio. Also have Land Research, and I also have ADI. So I have about 4 to 5 like semiconductors, and with this, it also pays out a annual dividend of $2.40, and then it has grown its dividend for the past 5 years at 11.46% with a dividend yield of 1.02. But man, it pays a dividend. You have that, but the bread and butter of SMH is growth. Last 5 years, a person was able to get 124%, and then last 10 years, 575%. Do 575 divided by 72, rule of 72, you would have seen if you would invest your money 10 years ago, how much your money would have doubled. I'm not even going to do all that. It's bonkers. The last ETF we will talk about is called SCHG. You probably haven't heard about that as well. And so basically, for SCHG, I'm giving you guys ETFs of growth, growing your money fast, either in your retirement accounts or in particularly your taxable account, so that you want to probably sell for a rainy day. SCHD is with Charles Schwab, and what makes SCHG to be on this list is that it's also invests heavily into tech, and then it also breaks down consumer defensive, healthcare, consumer cyclical, and if you look at the top 10, it's basically the same as the others, with a little twist. You'll see that it has the tech companies, but then you have United Healthcare, which is healthcare, and then I thought it was another company outside of tech, but you see, it's heavy in tech, so it's heavy on the growth. When you look at the expense ratio, the expense ratio is 0.04, which is good. Under anything under uh, anything close to 0.01 is great, and 0.04 is close to 0.01, so that's great for in terms of fees being taken out to pay the advisors. And also SCHG pays a dividend. It pays a dividend of 0.50%. It's really low, meaning that it's heavy on the growth side. But most importantly, SCHG with VUG and with SMH, the semiconductor ETF, are just great ETFs for individuals to do research. They want to grow their money fast. Give you options outside of QQQ. And so typically what individuals tend to do is that they tend to have one main fund, VU or VTI, for like stability because of the diversification. And then individuals tend to pick at least one or two ETFs outside of VU and VTF to invest into. It's called like the core the satellite method. And so basically you have your core position, which would be VU or VTI. You invest in VU, you invest in a diversified 500 companies, or VTI, the whole stock market, right? So very stable, diversified. And then what people tend to do is go with the more risky. And so they tend to either invest into QQQ or VUG or the semiconductor ETF, which is SMH, or SCHG, or just they probably split up where, maybe 50% in VOO, 25% in VUG, and 25% in SMH, the semiconductor ETF. Or however you want to do it. And just give you an example, because a lot of times, in order to make the money, with more risk, it's more returns. So VU and VTI is a little bit more on the conservative side. Capital preservation. Sometimes also, if you have the years, and depending on how young the younger you are, the more you can swing at the fence and go with more risk investing tools, ETFs. And then everybody know also that stocks is the highest of risk. And then after stocks, then you get into the whole realm of crypto. And we all know crypto, you could be down 20%, and the next day it could be up 25, 30%, yeah. And so lastly, with these growth ETFs, I started where you started with an investment of $500. You are investing $500 per month, and I did an interest rate of 18%. Normally, when you do with VU or VTI, it's the broad market, just ETFs, or just standard ETFs like the VU or VTI. They tend to produce returns about 10 to 12%. But the reason why it's high is because these are segmented, where it's either growth or consumer discretionary. So remember, niche investing. And with these niche investing, we're just investing into growth. When it's a bull market, you can see returns over 18%. You like typically VUG, the semiconductor ETF, and then also SCSG throughout a bull market, you can see them getting returns of upwards of 20%, 25%, especially the semiconductor ETF. the semiconductor ETF have actually have produced returns of upwards, I want to say, 25 to 30% per year. So it is possible. Now, don't get me wrong. Again, past performance does not guarantee future performance, and you may encounter some snags in the market like last year. But for the most part, these ETFs have produced returns of 18% or more. And as you see right here, the flow of your money and how it grows. And even within 20 years of just investing $500 per month, you can have a portfolio of $1 million within 21 years. And that's only just $500 a month. If you were to double it with $1,000 per month, you can reach your goal within half the time, 10 years. So just think about it. Take consideration the mistakes that new investors tend to make when they do research on their own dividend strategy or what stocks to invest to for high returns. Pay attention to those mistakes, learn. Here's some interesting ETFs for you guys to do research and look into. And hopefully you guys enjoyed this wonderful content and enjoy your Wednesday, February 22nd. And I'm out, man.